Well, I'm really excited today because I'm going to talk to you about one of my favorite income producing asset ideas. AI is currently changing the investment game in this space, so you'll want to pay attention or you may just fall behind. What if your computer could buy and sell investments while you're working, sleeping, or just sitting on the beach pretending to answer emails? Well, it can, and it's called algorithmic trading. It's about computer code making the investment decisions for you, and algorithmic trading has exploded in popularity. You don't need to know how to code. You don't need a PhD in mathematics. And in the past, algorithmic trading was only done on supercomputers at high-end investment institutions. But there are thousands of models available to regular people who can now benefit from algorithmic trading too. Today, I'm going to explain what algorithmic trading is, how it compares to day trading, why I think it's one of the more interesting cash flow strategies available today, and why you need to be selective when choosing one because it's not the magical ATM machine that social media wants you to believe. I'm also going to show you where to find my favorite algorithmic trading software. But let's start at the beginning. Algorithmic trading, often called algo trading, simply means using a set of pre-programmed rules that a computer follows to automatically buy and sell investments. Think of it like putting your investments on autopilot. Instead of saying, I think SpaceX looks good today, you tell the computer something like, buy when this happens, sell when this happens, and stop trading if losses reach a certain amount. The computer follows those instructions exactly. No emotions, no panic, no fear of missing out, no revenge trading after a bad day. If you've ever made an emotional investing mistake, congratulations, you're going to appreciate algorithmic trading. Here's what people don't tell you when they're making trades themselves. People aren't usually bad investors, they're emotional investors. Has this ever happened to you? You buy something, it goes down, you panic and you sell. Then after you sold, the price skyrockets, as if the market always does the opposite of what you want it to do. Algorithmic trading doesn't care. That's the beauty of it. It doesn't have feelings. It doesn't revenge trade. It doesn't say, this time it's different. It just follows the rules of the algorithm. Sometimes that's exactly what makes it better than us. Now, compare that to day trading. Day trading looks exciting on YouTube. Three monitors, some fancy keyboards, charts flying everywhere, and a guy yelling, let's go. But I bet you didn't know this. Most day traders spend hours glued to their screens, making hundreds of tiny decisions every day. They then have a sleepless night worrying about whether their investments are what they're going to do the next day. Algorithmic trading flips that. Instead of babysitting charts, the software does the babysitting for you. I don't know about you, but I'd rather let the robot work while I go and play golf or spend time with family or literally do anything other than watch little green and red candles dance around all day. That's what income automation is all about, creating systems instead of another job. Here's a simple comparison. In day trading, you make every decision. It's highly emotional, requires constant attention, and it's difficult to stay disciplined. With algorithmic trading, rules make the decisions. Emotion is removed, and it can automatically run consistent execution every single time. That's one reason many professional investment firms rely heavily on algorithms. They know emotions are expensive. Now, let's answer the multi-million dollar question here. Can this actually create cash flow? Potentially, yes. Many algorithmic traders are looking for lots of small, repeatable gains. Think of it like owning a vending machine. Nobody gets excited when someone buys one bag of chips, but after hundreds or thousands, those little sales start adding up. Algorithmic trading works similarly. Instead of hoping for one huge lottery ticket trade, you're trying to repeatedly capture small statistical advantages. Some investors withdraw part of those profits as income. Others reinvest everything to grow the account faster. Personally, I love anything that has the potential to become another income producing asset because every asset you own is one less hour you may have to sell. So why do people like it? Well, it removes emotion, and emotions are expensive. Also, it's disciplined. The computer never wakes up and says, you know what? Let's ignore the plan and try something completely new and untested today. Algorithmic trading is fast. Computers react in milliseconds. Humans react after checking Twitter or watching CNBC and then buying at the exact wrong time. And finally, time. Most people don't want another full-time job. They want another stream of income. And that's a huge difference. Now, let's talk about reality and the not so good stuff. Algorithms lose money too. There, I said it. Markets can change quickly and strategies don't always work 100% of the time. What crushed it 2 years ago may get crushed today. Also, technology can fail. The internet can go out, software glitches, bad market data, and computers occasionally decide to remind us who's really in charge. And here's the biggest mistake beginners make. They think because a strategy made $1 million on historical charts, it's guaranteed to work tomorrow. That's called overfitting. It's like living in the 1990s and saying the Dallas Cowboys will always make the playoffs. How'd that work out the past few decades? Not too good. So you'll want to choose an algorithm that has performed well historically, but temper that with a good risk management strategy so you don't lose your investment on something like a black swan event, which is when something happens in the market that's considered a super rare event, like seeing a black swan. But most people who do algorithmic trading miss out on this. AI has changed algorithmic trading dramatically over the past few years. Traditional algorithms follow instructions. AI writes its own playbook. Here's what's changed. Traditional algorithmic trading is based on explicit static rules. The program says, if this happens, then do that. The computer never changes these rules unless a human changes them in the program. AI trading systems work differently. Instead of being told exactly what to do, they're trained on enormous amounts of historical data and try to identify patterns humans might never notice. They're learning probabilities instead of simply executing instructions. Traditional algorithmic trading is like hiring an employee who follows your instruction manual perfectly. AI trading is like hiring a really smart analyst who studies millions of examples, makes recommendations, and keeps improving, but who can still be wrong. Neither guarantees profits. The goal isn't to predict every market move, it's to improve the odds over thousands of trades while managing risk. So where can you find a good trading algorithm? Well, there's plenty being peddled on the social media, but here's a high-level list of what to look for. First, make sure it actually automates trades and just doesn't alert you to make a trade. Make sure the software provider has a transparent strategy. Beware of proprietary algorithm providers that can't explain the basic principles that the algorithm follows. You want to look for strong risk management. You want to be able to adjust your own risk tolerance and have built-in mechanisms that protect your investment. Look for long, independently verifiable performance history. Backtests are useful, but has it been tested for both bull and bear markets? Has it been tested during low and high volatility? Algorithms come with a cost, so the software fees should be reasonable. Higher fees eat into your returns. And make sure it has simple integration with a reputable broker. Beware of any algorithm provider that takes control over your money and limits your access to it. You want software that works with a broker that you trust and allows complete access to your capital. And with any product you buy, make sure they provide any support that you may need. Notice what's not on my list. Highest advertised returns. High returns without context usually means high risk. So watch out for the ads for algorithms that promote super high, unrealistic returns. So which company do I use for my algorithmic trading software? Check out my tactics page on income-automation.com. I will share with you the company I trust and tell you why I trust them. I also provide a direct link to them so you can learn more about their AI-driven algorithms. Also, if you like the idea but don't have capital to invest right now, consider our partner program that allows you to build an income-producing asset without investing large amounts of capital. You can learn more about the program on income-automation.com. So as we wrap this up, I want to share my philosophy. I don't look at algorithmic trading as some get-rich-quick scheme. I look at it as another potential income-producing asset, one that can generate better than average returns, but also can come with some real risk if rules protecting your investment aren't baked into the model. Algorithmic trading is another tool and can generate another stream of cash flow. So in addition to your dividend ETFs, crypto investments, maybe you own rental property or you own a business, algorithmic trading can become another piece of that puzzle. So the big question is, would you trust a robot with your money? If the answer is no, just remember, humans invented Beanie Babies as an investment. So maybe the robot deserves a chance. And remember, the goal isn't to work harder, The goal is to own more things that work harder than you do. That's income automation. If you found this video helpful, hit that like button, subscribe, and leave me a comment below. And I'll see you on the next video.